Let's see, Pappas traders, what I like about this question. It is about the first question that we've done where they actually ask you the accounting policy notes. So make sure that you can write the accounting policy notes. Make sure exactly you know what the wording is for the accounting policy notes. And then furthermore, it also tests a few other principles. The pre-adjustment trial balance as at 28 February was as follows. Capital, drawings, mortgage loan for land and buildings, creditors, short-term bank loan, cost price of land and buildings, vehicles, furniture and machinery, and accumulated depreciation for all your classes of assets. Debtors, allowance for credit losses, listed investment at cost price, financial asset in other words, a VAT control. Now, please note that the rate that you have to use is 10% in this question. So if you've missed this little bit, you have missed quite a lot and a lot of your calculations would have been wrong. Fixed deposit also part of financial assets, 12,000 Rand. Inventory as at the beginning of the financial year, 1 March 2008. Then it's bank, nominal accounts, sales, purchases and imports, purchases returns. Let's get rid of that purchases returns right away. Less 1750. And we're going to close it off immediately, and all other adjustments we will do against purchases itself. Sales returns, let's get rid of that one, 1,400. And any other further adjustments we're going to pass will be against sales. Shipping charges in is purchase related costs. Same applies to customs and duties, and the same applies to freight on purchases. Freight on sales, that is a normal operating expense, guys. You do not deduct it from sales under no circumstances. You show it as a normal expense under your gross profit line. Bad debt, that is still a bad name for credit losses. Discount, look at this little one here. What an evil account. And I have a debit and a credit account. Now, without telling you anything more about discount, I don't know whether they do tell you. Oh, there. They told you that through the year, discounts were mistakenly still recorded in separate accounts. Now, they were very kind to tell you that. They didn't have to tell you that because you should know yourself that you have to get rid of that. Discounts granted will be an expense, and that will be a debit balance, and that will be part of sales. So we're going to credit that account and debit sales. And then also what we're going to do is, so we're going to take it out. And we're also going to take the 363 Rand out. So the 363 Rand is a credit balance, so therefore it's discount receive. Now where do we receive discounts? We receive discounts on purchases. So we're going to debit that account, discount 363, and we're going to credit that account 363. Good, I don't know why suddenly we have it here in bold, but nevertheless. Good. Interest on the loan, 5040, dividends on listed shares. That is the return that I earn on my financial asset, which is my investment in shares. Somewhere along the line, we had investment in shares. There it is, listed investments at cost price, 14,000 Rand. Good, then sales commission. This is a normal operating expense. Under no circumstances you deduct it from sales. Advertisements, insurance, rent received, general expenditure, and stationery. Good, let's start with additional information. Additional information to consider where necessary. Inventories on hand, 14,400. Stationery up to 28 February, 174 Rand. Now, they require from us to do the statement of financial position. You can assume that the profit for the year was 93,169. Now that means you don't have to redo the income statement. However, I'm going to show you the income statement in this question as well, so that you can have the full picture of what the disclosure looks like. But if they give you a profit figure and they tell you that you have to use that profit figure, then you do use that profit figure as is. You do not try to prove me wrong. You can assume that the profit for the year was 93,169. So if there was any further adjustments that you have to make, well, if that is the closing figure, then it will only be on the statement of financial position. Disclose the following notes to the financial statements. The accounting policy note for inventory and allowance for credit losses. That's not allowance for credit allowance, credit losses allowance. Inventory, trade and other debtors, and trade and other creditors. So they want the inventory note over and above the fact that you have to give them the accounting policy note. So you know that your inventory note will be these two items. You will have trading inventory of 14,400 and you're going to have a stationary consumable stock of 174. In order to achieve that 174, you will have to deduct stationary here minus 174. Good. Inventory is valued on the first in first out method, and that obviously is going to be recorded in your accounting policy note. The following depreciation must still be provided for the year: vehicles, machinery, and furniture and equipment. So you're going to add that to accumulated depreciation for each. Vehicles plus 3750, furniture and equipment, you're going to add with a current year's depreciation, which was 9, furniture and equipment is the last one there, 4440. And then machinery, you're going to add to your accumulated depreciation, the depreciation charge for the current financial year of 9575. Good. Next one there, number 3. They tell you the mortgage loan is subject to interest at 18% per annum. The loan was effected on the 1st of September. That gives us 6 months as from the 1st of September up till the end of the financial year of 28 February, and is repayable in half-yearly capital installments of 3,500 Rand. The first date is 1 April 2009. So only in the next financial year. Now, if you look at our mortgage loan was for an amount of 56,000 Rand. So here, 56,000 Rand. We're going to multiply that by the interest rate of 18%, and that we're going to multiply again by the period that this loan was outstanding, which equals 6 months. And after we've done that, it means that we should have had interest in our books of 5040. If you go to our income statement, you will see that we have interest on loan of 5040. So that loan, interest on that loan was fully provided for, so we don't have to pass any adjustment entries. Here, the bank loan was effected at an interest rate of 23% per annum. Now, we can only assume that this bank loan was outstanding for the full year. So for that one, we going to have 4,000 Rand multiplied by 23% for the full year, and that is going to give us total interest of 920 Rand. Nowhere here is the additional 920 Rand. So interest is going to increase with 920 Rand here. And now, guys, we have to make provision here for accrued interest. So I'm going to add here at the bottom of our page, what is the additional entries that we're going to need. Good. So here we're going to have, I hope I can write it here. Accrued interest. And that amount was 920 Rand for the year. Good. Now we can continue, and you remember accrued interest, obviously what we want here is all our credit amounts, and credit amounts is going to form part of our trade and other payables note. Good. And let's do here simultaneously all our debit entries. And that is going to form part of our trade and other receivables note. A debtor is insolvent. We receive 66 Rand from his estate, which represents 30 cents in the Rand of his outstanding debt. So, we have received 66 Rand. That represents 30% of his outstanding debt. So that means the full amount of his outstanding debt is 220 Rand. So if his full amount of his outstanding balance was 220 Rand and we have received 66 Rand, how much are we going to write off? 154 Rand. Now remember, our VAT rate is 10%. So that means that the VAT included in the 154 Rand equals 14 Rand. So what is the amount that we're going to write off? We are going to write off an amount of 140 Rand. So there we're going to add 140 Rand. We're going to claim the VAT of 14 Rand. There's a debit balance, so therefore we're going to add it there, plus 14, and put yourself in brackets a D, so that you know it's a debit entry that you're going to pass. And what are we going to credit? We are going to credit our debtors with a full amount of 220 Rand, and in our bank we're going to have an amount of 66 Rand. And then this thing should balance. Okay. The next one. The allowance for credit losses must be set to 10% of trade debtors. Ignore VAT for the purpose of this calculation. So our trade debtors is going to be, if we look at our trade debtors, 14,610 less 220 Rand. So the balance of our debtors is going to be the net amount of 14,390. 14,610, the opening balance, less the 220 Rand, which was number 5 there. Good. So that multiplied by 10%, and they say ignore VAT for the purposes of this calculation. So that gives us then 1439. If we go back to our trial balance, then we have an existing balance there of 900 Rand. So in order to bump that balance up to 1439, we're going to need an adjustment entry of 539. So that amount there is going to become an amount of 1439 at the end of the day. Now, to pass that entry, we're going to credit the allowance for credit losses with a 539, and we're going to debit our adjustment for credit losses account, 539, and for the purposes of this, I'm going to put this here against this very ugly naming of bad debts, plus 539 there. Good, the next one. Rent is subject to an annual increase of 5% on 1 July. The lease has already been received up to 31 May 29. So we are end of February. So February, March, April, May, we have then received 3 months of rent in advance. So if we're going to work out our total rent, we would say, well, from 1 March, which is the beginning of the current financial year, up to 1 July gives us a total there of 4 months. So in total, we have received 3 months rent in advance. So if we're going to write this down in a format of a formula, we're going to say that the total rent that we have received was 3732. So we're going to say 3732 equals a total of 4 months with a normal rent of X plus we have received then 11 months at a rate of X times 1.05 because we've received in total 15 months of rent. 12 months for the year plus 3 months in advance give us a total of 15 months. 4 months was at a normal rent of X. 11 months was at an escalated rent of 1.05x. If you're going to resolve X now, then X is equal to an amount of 240 Rand. Now, the rent that we've received in advance is not equal to 240 Rand. Our rent received in advance is equal to 240 Rand times 3 months times 1.05, and that's giving us an amount of 756 Rand. So what do we want to do with 756 Rand? Remember, we've already received the rent, and when we did receive the rent, we actually handled the VAT on that amount that we have received. So under rent received, we want to decrease that rent received with 756 Rand. What was that? That, guys, was income received in advance, which got a credits balance, which will form part of trade and other creditors at the end of the day of 756 Rand. Good. The next one. Withdrawals of trading stock by the owner to the amount of 550 Rand, VAT included, have not yet been recorded. So if we take the 550 Rand, we divide it with 10%, take the VAT out, it gives us a VAT exclusive price of 500 Rand. So what are we going to do with the 500 Rand? We are going to reduce our purchases with 500 Rand. That is VAT output that we have to pay back to the receiver of revenue, 50 Rand. So that's going to be a credit against that account. And then the 550 Rand, the sum total of it all, we have to add to our drawings. Remember, they want a statement of financial position, so therefore we have to do all these adjustment entries against all the transactions that affects the statement of financial position. Imports represent 25% of net purchases. Customs and duties are calculated at 20 cents per 5 Rand VAT exclusive. So if we're going to look at our customs duties as indicated in our trial balance, we see that customs duties there is equal to 988 Rand. They tell us that customs and duties on purchases amounting to 2,000 Rand VAT exclusive have not been recorded. So it's not included in the 988 Rand. So if we take the 2,000 Rand and we say, well, for every 5 Rand we have to pay 20 cents worth of duty. So that means at the end of the day, the amount that hasn't been recorded equals a total of 80 Rand. So what are we going to do? We're going to increase our duties with 80 Rand. So we're going to debit this account. What account are we going to credit? Going to credit accrued expenses again. For that 80 Rand that we still have to make provision for. Good. Advertisement expenses include costs to the amount of 440 Rand VAT included with regard to an advertisement that will appear in March 2009. So clearly there was a prepaid expense. Prepaid expense was 400 Rand. We've dealt with the VAT when we made the payment, so there's no VAT implication at this point of time. but we have to reduce our advertisement expenses with a VAT exclusive amount of 400 Rand. So we're going to credit this account with 400 Rand, and we're going to debit here under that side prepaid expenses, 400 Rand. Right, insurance is payable in 3 installments exclusive of VAT, 1 July, 1 September and 1 January. The latter premium was still owed at 28 February. The VAT on this amount was already claimed, although the expense was not recorded as yet. So therefore we have to do the expense. Our insurance that we still need to report is 900 Rand. And again, under accrued expenses, that is also accrued expense, 900 Rand. So that you're going to add to the other 80 Rand that's already lying there. A statement with a balance of 2,000 Rand was received from a foreign creditor. It includes 1,800 Rand with regards to owed monies. Now we can assume that we've already recorded that 1,800 Rand because this is now according to a statement, not according to an invoice. But on the statement, we have this thing that they call interest. They have lodged 200 Rand worth of interest against us. So if interest is not subject to a VAT, so interest here, just put it in there, interest expense, 200 Rand. And what has that interest done to my creditors account? Well, that interest that I have actually passed on the statement would have increased our creditors balance. So therefore we're going to increase our creditors and not accrued expenses with that 200 Rand worth of interest. Good. A policy to group all accounts payable, accounts receivable, blah, 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 and that's all fine because we should know that it should not, it's according to IFRS, you have to do that. You don't have much of a choice in doing that. If we go to our answer now, let me just quickly show you that if I do my income statement from the beginning, and I start with all the items that I actually gave me in my trial balance, which is income statement items, i.e. all those items exclusive now up to the interest expense. And I'm going to record that with all my adjustment entries in my income statement. You will see that if I've done it correctly, at the end of the day, my income statement is going to balance back to my net profit for the year of 93,169. So if you're going to have a look at your question, and I told you in the last additional information here, no, it was in the given part, in the required part, they said that you may assume that your profit for the year was 93,169. There I've showed you how we have actually derived at the 93,169. Now you can have a look at that by just passing all the adjustment entries that we've done up till now. For the rest, it is straightforward. What I would like to show you though is just a few of them. That purchases will be after we have done all the adjustment entries that we've already discussed. Customs and duties is after we've added the 80 Rand, which we've already discussed. Here was a 756 Rand, which was rent received in advance, which we have already discussed. Now what I would like to show you here is operating expenses. Under operating expenses is your freight charges on sales. You see it's a normal operating expense. Credit losses is with all the adjustments. Here's our sales commissions. It's a normal operating expense. Under no circumstances it forms part of our sales there on top. Insurance is with our adjustment entries. Advertisement is with our adjustment entries. There's nothing that happened there. Here's our interest. Our interest was for the 200 Rand of the creditors, as well as our interest on that bank loan that we also had to add. And here was our interest received, and there that was the whole katoot in the income statement. So what I would like to focus on is in our statement of financial position. So let's start with our notes. First note is on inventory. And guys, you must use these same words. Inventory is shown at the lower of cost or net realizable value on the first in, first out basis. Then you must explain what is net realizable value. Net realizable value is the expected proceeds that can be earned by selling a product after all compulsory selling costs have been deducted. Your accounting policy note on allowance for credit losses. The allowance for credit losses is calculated at 10% of, it's actually outstanding trade debtors at the end of the financial period. Let's do that. At the end of the financial period. There you are. Then notes. Now maybe you cannot see that so clearly anymore. Notes in the financial statements for the year ended. Again, the year and the rand amount. Inventory. Inventory consists of trading inventory, which was 14,400. Stationery or consumable stock on hand, which was 174 rand. And then it will give you a total then at the end of the day of 14,574. And that will be the amount on your statement of financial position. So on your statement of financial position, I will talk about that now. Under current assets, inventory 14,574. Good. Our statement of financial position will have a proper heading, the name of the entity in a different line item, statement of financial position as at 28 February 29. Now, non-current assets, property, plant and equipment, not vehicles, furniture and fittings, and all three those things. Up till now, we've seen that those three things will be recorded in the note, and that note was not required from you to do. So therefore, you will only have one line item, property, plant, and equipment. Now, if you go back here, that obviously will be equal to the cost price of my property, plant, and equipment, which will be those figures, plus our accumulated depreciation, and that accumulated depreciation in the beginning of the year, plus our current year's depreciation charge. So if we're going to add it all together, now that accumulated depreciation, it's those last three entries there, and that includes the current year's depreciation. If I add everything up, then it is then a total of 246,510. Financial assets, a one-line item. There is a note that explains the makeup of the financial assets. And let's just have a look what it consists of. This one consists of our listed investments of 14,000 and our fixed deposit of 12,000. Now you should know that you have to distinguish in your note between investment in shares, and under investment in shares, you should note investment in listed shares at cost price 14,000 rand. And then another subheading under financial assets, cash investments, and under that fixed deposit with all the particulars of the fixed deposit, the interest rates, where the deposit's being held, and the period of the deposit, the length of the deposit, you would have then had 12,000 rand underneath that. So in total, my financial assets equates to 26,000 rand. Good. Current assets we've done in inventory. Let's look at trade and other debtors. Now, a note on trade and other debtors will look as follows. Trade and other debtors consist of gross trade debtors, and again there we have deducted the 220 rand from our debtors, so the final figure would have been 14,390. Less allowance for credit losses. Now guys, please, it is our closing balance, our 1439, not the adjustment entry, that goes to the income statement. But that 1439, that being our allowance balance at the end of the year. So our net trade debtors will be the difference between the two, 12,951. Now our VAT, we have here VAT. We've started off with a debit balance of 2,000 and we did a number of accounting entries against that VAT control account. So that was the 2,000, the 14 Rand on the credit losses and 50 Rand on the drawings. And that gave us a final debit balance. So that is why it's under trade and other receivables of 1964. Then prepaid expenses. Remember here, we have added here at the bottom of the page our prepaid expenses of 400 Rand. So there it is. Good, and that gives us a total of trade and other receivables of 15,315. Our bank and cash balances here was a credit balance. So therefore, there will nothing appear on the asset side for bank and cash. You don't have to show it if it's got a zero balance. So that gives us in total assets at the end of the day of 302,399. Then our equity and liability side of the statement of financial position. Now here you have to show the movement that took place on equity for the current financial year. Oopsie. So we will start with our balance as at the beginning of the year. Have a look there. And our balance at the beginning of the year, 129,365. Then our profit for the year, as per the income statement, will be added to that amount, 93,169. Add the profit for the year, 93,169. That will give us a total of 222,534. Then we're going to deduct our drawings from that amount. So our drawings was the 4,890 plus the 550, which will give us then 5,440. So net equity at the end of the period will be equal to 217,094. The non-current liabilities, that would be my mortgage bond. Now, remember we had the two loans. We had the mortgage bond and we had a bank loan. Now, a bank loan, they tell us here it's a short-term bank loan. Because they tell us it's a short-term bank loan, it's not going to be form part of our non-current liabilities. So only our mortgage of 56,000 will form part of our non-current liabilities. But now remember, we have to transfer the short-term portion of the long-term loan to current liabilities. So if you go to the details of your question, they tell you here somewhere along the line, the mortgage loan is subject to interest, the loan was affected, and is repayable in half-yearly capital installments of, oh dear, the amount there got lost. So what that amount was is an amount of 3,500 Rand each and every time. So half yearly, so there's going to be two payments of 3,500 Rand next year. So therefore the total of 7,000 Rand has to be transferred to my current liabilities. My short-term bank loan will also be shown here as a current liability, the total of 4,000 Rand. Trade and other creditors. That consists of our trade creditors of 19,800 Rand. It was 19,600 Rand, sorry, plus the 200 Rand worth of interest that we have capitalized against the account, which gives us in total 19,800. Accrued expenses. Remember what we've added here at the bottom of the page? All of these must be somewhere. Accrued expenses, there's accrued interest of 920 Rand. There was the 80 Rand customs duty and the 900 Rand, I think, insurance. So if we add that all together, it gives us total accrued expenses and then 756 Rand interest received in advance. So 920 plus 80 plus 900 gives us 1,900. Income received in advance 756. So that gives us total trade and other creditors of 22,456. Our bank overdraft was the amount that they gave us, bank 2915, less the 66 Rand that we have received on the debtor, which was subsequently been written off, and that then gives us a total there of 2849. So total current liabilities 36,305, and that will give us then total equity and liabilities of 302,399. So if I'm going to compare that with my asset side, that also gives us 302,399. Please make sure that you know exactly how to disclose the items. I'm talking about property, plant and equipment. I'm talking about financial assets. I'm talking about non-current liabilities. Remember to transfer the short-term portion here to the to the current liability side. That is the total. It must be there. To the current liability side. Make sure that the short-term bank loans are also being shown as a current liability and not as a non-current liability. Make sure that your bank overdraft then will then be featured here under current liabilities because it's got a credit balance and not a debit balance. Make sure that you know exactly what your accounting policy notes look like, what you should disclose under accounting policy notes. One should be there as well. And make sure that from there on further that you know exactly how the disclosure should take place.